Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, July 16th. On Wednesday, the financial sector soared the most in its 19-year history after Wells Fargo reported better than expected earnings, sparking a rally that was compounded by short covering. As a result, the stock market posted a large 2.5% gain as a steep drop in crude prices helped overshadow a disappointingly high inflation reading. Wells Fargo reported second quarter earnings of 53 cents per share, topping Wall Street's expectation by 3 cents. In addition, the San Francisco-based bank raised its dividend by 10%, indicating it is in a solid financial position despite the current environment. Wells Fargo spiked 32% on the news. This, along with better-than-expected earnings from Charles Schwab, Northern Trust, and Marshall & Easley, sent the financial sector soaring to a 12.3% gain, the largest advance since it was created in 1989. It was a solid session outside of financials as well, with 8 of the 10 economic sectors posting an advance, aided by the second straight day of tumbling oil prices, bargain hunting, and short covering activity. With regard to crude oil, prices fell 3.1% after a government report showed an unexpected crude and gasoline inventory build, sparking a rally in energy price-sensitive areas. The consumer discretionary sector jumped 4.4%. General Motors and Ford posted their largest one-day percentage gain in years as investors scooped up the beaten-down names. Meanwhile, retailers spiked 5.5% as oil prices eased. Airlines surged 18% thanks to the drop in crude prices and better-than-expected earnings from American airline parent AMR Corp and Delta Airlines. Other beaten-down areas saw a surge in buying interest. The home builder group spiked 14%, while the building products group rose 11%. The technology sector performed roughly in line with the market, unable to outperform despite Intel reporting earnings that topped estimates. The semiconductor giant's margins were on the low side of previous guidance, which kept buying interest in check. The energy sector was a laggard after the drop in crude prices took a toll on oil producers. Meanwhile, the defensive-oriented utility sector slipped 1.9%. On the economic front, June inflation rose by a higher-than-expected amount due to rising energy and food costs. Core inflation was also higher than expectations due to larger increases in the indexes for shelter, tobacco and smoking products, and the apparel index. Specifically, June CPI rose 1.1% month over month, higher than the expected increase of 0.7%. Core CPI, which excludes food and energy, rose 0.3%, which is also higher than the consensus estimate of 0.2%. CPI is now at 5% year over year, which is its highest level since 1991, and core CPI is up 2.4% year over year. Industrial production rebounded to a 0.5% gain in June from a decline of 0.2% in May. That gain was due in part to a 5.4% increase in the output of motor vehicles and parts as activity resumed at plants that had been idle during the American Axle strike. Separately, capacity utilization increased to 79.9% from 79.6%. Fed Chairman Bernanke gave his semi-annual testimony before the House Financial Services Committee. Much of his testimony was a rehash of the appearance before the Senate Banking Committee on Tuesday. Of note, the chairman said the GSEs, which are Fannie Mae and Freddie Mac, are adequately capitalized and in no danger of failing. He went on to say that action by Congress is justifiable in order to raise confidence in the GSEs. The minutes from the FOMC meeting from June 24th and 25th were also released this session. The minutes did not provide the market with any new information and as a result had a limited impact on trade. I'm Pat O'Hare for Briefing.com. Thanks for listening and have a good evening.